Started here today. I want to welcome everybody to our strategy session. It is February 11th. We're going to get things kicked off talking about our road series that starts on the 18th, Monday. We've got two different spots we're going to be out in South Dakota, also Davenport, Nebraska, and then followed up we're going to be in Mankato, Minnesota, and Riverside, Iowa some of the following days. So if you're in those areas and can make these meetings, certainly go online, get registered. It's a free meeting for you. We will have food provided as well, but we're also going to go through our 2013 outlooks. It's a great way to get this marketing season kicked off. We know the markets right now certainly don't look so good, but may give us an attempt here and to get some marketing done and have a strategy put together for you to get things kicked off this year. So with that said, feel free to go online, get registered, and I'm going to turn things over to Rich Nelson. Take a look at the grains. Go ahead, Rich.
All right, thanks a lot, Steve. So at these Friday's discussion as far as USDA's report, we did see some minor changes to the corn balance sheet. We're not going to go into numbers too much detail, but bottom line, they were using 602 for ending stocks. Now they're using 632 million bushels for old crop ending stocks. As far as changes, they did go ahead and adjust exports a little bit. They didn't touch ethanol or anything like that. So in the coming months, there still is going to be further changes to actually both exports again, as well as ethanol. So bottom line for corn, we know that as far as old crop demand, it's a serious issue, and we will see continued increases in old crop ending stocks. So really for corn, if we're looking for good news, we're not going to find it on old crop information. So that's strike one here for us. Once we look over here at soybeans, and if we can, there we go, thank you. As far as soybeans, minor changes we saw, 135 million bushels is what they had for old crop ending stocks, and they just dropped it down to 125. Interesting enough, they did not make any changes for exports. They made the change only in domestic crush. And we'll talk about this export issue here, which is still in front of us and still does give us a small carrot to look at for maybe upside potential here. And we'll talk about that here in just a second. Over on wheat, 716 was what they're using for old crop ending stocks, and now they just brought it down to 691. A little surprised, though, they made this changes only on the feed and residual use category. That was a little surprise there. But bottom line for wheat ending stocks, these are still not tight. 800 or so from the last couple of years. These are still kind of average levels right now. Now let's just kind of go from this Friday issue to what's in front of us right now. What's in front of us for this week and what maybe has changed a little bit here. South American weather. We will point out that the forecasts do show some changes here. Over the weekend, as far as Sunday, Argentina saw less than a half inch of rain. And according to our good friend John D., we have two separate rain events lined up for Argentina in the next few days. One running into tonight and tomorrow. The second one running late this coming weekend. So Argentina will receive some rain, and maybe not enough to replenish dry conditions, but certainly a change in the forecast. So we've got to point out that has changed since Thursday, Friday. As far as this issue with southern Brazil, they do have rain also. So not only did they get up to 3/4 of an inch on Sunday, now they have two separate rain events, and each of these are actually a little larger than Argentina. First rain event spread out over the next few days, ½ inch to 1.5 inches, and a little more, or up to 1 inch, coming late this weekend. So that's changed, and that's also showing adequate moisture right now. Last issue here is, of course, for central and northern Brazil. They've been seeing mostly normal rainfall. Some areas actually a little more than what they needed. But bottom line is, over the next few days, they're going to see each day 10 to 30 hundredths, small chances of rain over the next few days. So as far as all these areas, you can point to a change in the forecast and maybe a change in psychology. So that certainly has changed since last week. While that's a little bearish, one thing we mentioned is soybeans still have this chance of upside, and that's certainly on the U.S. export situation here. If you look at this blue line, just the dotted blue line here on this chart of weekly export sales, from here on out, we should be dropping hard. We're already in the time frame where Brazil should be getting all these sales. And last week's export sale actually was pretty darn good. You see that red line showing the red line here far above this normal. So we still have evidence that we're getting extra sales on soybeans that we normally wouldn't be at this time of year. So that's certainly a very good situation here. And if you look at this this kind of breakdown, USDA says 1.3 billion bushels. We've already got 1.2, in fact, rounded up, almost 1.3 of that sold. And we've had some discussion in our pod in the past couple of days about, well, how about, are they going to cancel a lot? You know, maybe we've got a lot pre-booked, which we do, but maybe they'll cancel a bunch of that. And if you look at the shipping, in fact, shipping totals 1 billion of that. So there's only 250 million bushels outstanding right now. That's not a lot. If they do cancel, what are they going to cancel? Maybe 40 or 50 of that? So we still have a very tight U.S. export situation. And if you look at the shipping issue with Brazil and Argentina, there's reason to say we're going to get a few more sales. South American shipping delays currently running about 50 days. And they haven't even got into that clogged export situation, which is going to be mid to late March. So you've got to say, we're going to continue to get some soybean sales here, guys. Now, as far as pricing, we can point out that as far as pricing, you know, we are a little overpriced. We've got to admit this fact here. Once you compare the red line, which is the U.S. At the Gulf, and this thin line, I believe, is Brazil, we're running about an 8% premium over Brazil. So if it weren't for these shipping delays, the questions about how much can they actually send out in the coming months, you would say that, that we should be having almost no sales right now because we are low overpriced. So these shipping delays are helping us out and will help us out in the next few weeks. And this is a little different than corn. Here's the breakdown as far as corn pricing between the U.S. and Argentina. Right now we have about a 12% premium. And as far as that goes, you know, we're certainly overpriced, but it's really interesting to see the buyer mindset right now is they're just not concerned about corn. Their really need right now is soybeans. So let's kind of bring this home and kind of see what are some other issues looking at ahead here. So we've got these new baseline numbers. Here's a website for this baseline projections. You guys actually want to check that out. I'll send this link out here. Don't worry about writing the link down. There's a whole website for it. So here's a picture of the website. And if you click on this deal right here, USDA projections out to 2012 or 2022, that's what that is. And just as a quick reminder, what these baseline numbers are, the government is tasked each year with making projections out for the next 10 years for budget reasons. But these are made, actually they start in summer, and they finish up in November. So these numbers were made in November as far as these U.S. numbers here. So this is kind of old data here. And if we look at some of those numbers as far as acreage, here's the acreage breakdown, and this is what I emailed out earlier this morning. A little surprise. They're saying that of the main crops, 2.8 million lower acres. That doesn't make sense. There's nobody in the industry talking anything like that. And they're saying also on top of that, you're going to drop CRP by 2.0. And that does kind of make sense because at the conference we said 1.6 was our estimate. So they're saying a net decline in all acres, including CRP, of 4.8. With high prices, is that even realistic? And that's certainly the no is the quick answer to that one here. And here's the breakdown as far as acreage changes in the past few years, just to demonstrate we had high prices in 07 and 08, and we had, therefore, an increase in acres. high prices in 2012. We had an increase in acres, and we certainly say that we're going to get high prices again right now, and we're going to increase in acres. So what USDA told us with these baseline numbers, these are actually small ending stock numbers. Keep this in mind. So we've got more acres than what they told us here. As far as acres, USDA said corn acres are going to decline. No sense at all with that. Everybody in the world right now says we're going to increase acres. Also keep in mind these are made with a trend yield at 163.5. And that's the number we talked about at the conference that they probably would come out with. And they've got a big ending stock here of 2.1 billion bushels. And if you add in more acres instead of less, that's actually going to be bigger. So they're not going to give us these exact same numbers at the conference that they have in 2 weeks, but it's going to be something real similar to this. So big numbers is what's ahead of us. Over on the soybean side, they actually dropped acres as well. Everybody in the industry is saying we're going to have an increase. And numbers as far as ending stocks, 185 million bushels, maybe up to 200 or so once you drop in the higher acres. Over on wheat, we've got they've got a slight increase in acres, which people will agree with. And as far as ending stocks, 733, this is more or less considered neutral as fits in with what's going on in recent days here. So let's go with the bottom line here, guys. We're going to hear bad news throughout this month. USDA's conference in 2 weeks is going to remind everybody of these big numbers again. In fact, it might even be bigger because they said corn and bean acres will drop, and there's no way they're going to drop, especially with these high prices. So we've got rough news ahead of us right now. Really the question right now is what type of moderate balance can we get in prices between now and really March, April is really our main thing right now. We want to try and get this market sold before spring really hits. On that idea, we've got this acreage, this question as far as insurance prices. A lot of our customers are saying, I don't want to sell until I get this insurance price factored in. Here's where we're sitting at as of Friday as far as these February prices for corn. 581 is the insurance price there. And last year's average was 568. So this is still a very high number for corn as far as a February insurance price. And currently we're looking at 1328 for February insurance price. And that's clearly above last year of 1255. So these guys have a huge incentive to plant, corn and beans. They will have big acres. There's no doubt about that here. And like I said, our main question right now is actually what type of rally can we get from here in order to work on sales? Or is it past us? And we're going to take a look at those issues here this week. I will come out with, redo the price projections, take a quick look, see if anything's changed. But for right now, we're still saying a move back to $6 is still the place to sell. The outlook says up to $620, $640, but really we've got a question right now if that's even going to be realistic, especially because all these guys are going to get hammered over the head at USDA's conference in 2 weeks with even bigger numbers than what they said here with this baseline numbers. So we have some tough issues right in front of us here.
All right. Thanks, Rich. Let's turn things over to Monica. Take a look at the charts, see what she's got to say here on the technical front. And bear with us 1 second. We'll have that for you. Take it away, Monica, whenever you're ready.
We're looking at March corn once again, and you can see that with today's drop in the market, we did break this long-term uptrend that we had in place off of the summer lows here back in June. And we also broke this moving average here in yellow, which is the 200-day. So technically, this was a very weak close here today. We could revive this by a quick bounce here tomorrow and get us back above the uptrend. And if not, we do have some downside targets here. We've got this low at 687.5. This one is not far below it at 86.25. And then the January low here at 678. So quite a bit lower. There's not much to support us here until those levels. So we got to, those are realistic levels possibly here if we don't get a close tomorrow back above this uptrend. we've got resistance now here, the 714.5. That'll be our new resistance. So tomorrow could be pretty key as to whether or not we continue with some lower numbers here and head towards the 675 area, or if we can rebound and resume this uptrend real quick here. So I would probably hold off on making any, really trade decisions right now as far as jumping on the long side, trying to pick a bottom, or selling here and chasing it lower. I don't feel real comfortable about either of those, so I would wait and see what tomorrow's trade says and go from there, and just keep these downside targets in mind. Let's jump on over to beans. We're looking at the March contract here again as well. A huge drop here today too. Threw up some retracement levels here just to look at some downside targets here as well. We broke through a moving average. This one in yellow is also the 200-day. And today we easily fell through 38% retracement, which is 1442, and nearly hit 50% today at 1424 3/4. So based on this, we had a weak close here today as well, broke some key points on the chart. I wouldn't be surprised to see this 50% tested here maybe as soon as tomorrow. And got to watch 62% down at 1407.5 as well for the rest of this week. So once again, as in the corn, if we don't see a quick rebound tomorrow, some of these downside targets are pretty realistic here, so keep that in mind. Once again, just like the corn, I don't think I'd try and pick a bottom here. I think I would wait and see what tomorrow's direction looks like, just to give us some more information here and see if 50% looks like it's going to hold, or if we climb back above 38%, then that might give us an idea whether or not we could maybe step in on the buy side on things. So once again, just probably give this one more day to see what kind of direction we have tomorrow. And that's all I've got.
All right. Thank you, Monica. We're going to turn things back over to Rich, take a look at livestock now, and see what Rich has to say. Go ahead, Rich.
Let's cover some ugly issues with cattle. We're going to start out with the ugly facts, and then we're actually show some reasonable facts, which are just ahead. Here's the ugly issue. Year-to-date slaughter. So January into early February. Slaughter's down only 0.6%. So where is the big meat deficit? Where is this big beef deficit? So only 0.6% lower. And we know we've got weights. We've got these heavier weights. You throw in the weights, and here it is, up 1.4% higher. So year-to-date, we've actually produced more beef than last year so far. And we've got this question, where is this beef supply deficit? What the heck is going on? So we've got more meat plus this demand issue in front of us. Now it's got to explain where this extra meat's coming from, where is this lack of a deficit coming from, and let's kind of go from here. So cattle that are marketed in the month of January, these were placed May, June, July, and August. And you see this big May number. Actually, a lot of this increase was due to lightweight numbers, which hit right in this January time frame. So we're still dealing with this kind of May jump we had in terms of placements. And January feedlots slaughter was down 1.2%. And we know that placements in these 4 months were down about 2.7%. So this is not out of bounds. This is what should have happened for January. Now, more important is what's coming ahead right now. Because you see these 4 months here, well, how about for the month of February when we start to see that big drop in placements? Here's what the February marketings are made from. Placements between June, July, August, and September. Placements in that time frame, 11% lower than last year. This is what's coming right ahead in the next 2 to 3 weeks. Now, we're not going to see slaughter down 11%, but it's going to show a good drop, probably 6 to 7% lower. How about for March? If we shift all this rectangle one more move lower here, this is what the March placements or the March marketings are made from. Placements in this time frame were down 13%. So let's just make a main message that this meat supply deficit is directly ahead of us. And yes, it's been ugly for right now because we've had higher beef production actually, and poor demand. But look what is right in front of us here. We're now going to start digging into this very tight supply issue right ahead. Now for the short term, let's discuss this issue. Here's a week-by-week change in wholesale beef. We said wholesale beef has been moving lower recently, right? Like here's this big move down in last week in January, and then we've got this another one for last week. These are wholesale beef prices. They went lower in the past few weeks. And up until this point, cash cattle was also going lower. But look at the last 2 weeks of cash cattle to wholesale beef. While beef was going lower, what happened to cash? 2 weeks ago, it showed almost a $3 rally. Last week, about unchanged, just a bit lower here. So we've got this issue of tight feedlot cattle supplies right ahead. And 2 weeks ago, this market kind of shook us up by saying cash cattle had a big rally right in the face of wholesale beef doing nothing. So this is the message we need to look at right here. The last 2 weeks has shown cash cattle stability in the face of lower beef. I think what's going on right now is, yes, this market is finally saying this big tight supply issue, which we've been talking about for some time, is hitting now. So here's the message as far as cattle. Yes, this market has been slapping the heck out of us in the past few weeks. I'm not going to argue with that at all. Yes, it's been a horrible, ugly time. But this market is showing evidence that all this stuff is happening right now. It's beginning to happen. 132 at a minimum for this April contract, and it's got to be even more than that. So that's the message for cattle. It's been ugly, it's been disgusting, but it's changing right now. Wholesale beef versus cash cattle. What happened 2 weeks ago is showing that we're now in that time frame where the market's going to start pricing it. So that's the message here for cattle. Yes, this week's, especially the rebound that happened today, it might be the low. I'm not going to buy extra or anything like that here because of it. But we've got to wait and let the market tell us. But this stuff should be happening right now. Yes.
Are you going to watch the wholesale beef and that starts turning, and is that going to be a good indicator?
Jim said, how about this wholesale beef? No. I'm going to watch cash cattle. Jim said, well, what should we be watching right now? Should we be watching wholesale beef when we see these daily numbers change? I say no, because this is going to be a deficit at the feedlot side, cash cattle. I'm going to watch this week's cash. And if it holds or even rallies, then that's going to say, who cares what this wholesale beef demand is? Who really cares? This is a deficit in cash cattle, and it's showing up now. So I'd watch this week's cash. And if we see stability again, that's our sign. On the pork side, we don't have a lot of excitement going on here. Look what happens to pork supplies in the next few weeks. Weekly pork production is stable. Not a lot going on. In fact, maybe a slight increase if you look at what happened last year in the next 2 weeks, a slight increase. As far as prices, though, cash hogs did rally up until mid last week and then started to show a good drop in the last 3 or 4 days here. And if you look at futures right here, futures are down where they're going to say February 14th prices will be. Can't argue with this at all. This is a short-term bearish situation on hogs. Short term, we're still holding these short options. This is not a time to buy hogs yet, but it will be in the next few weeks. Keep in mind, on a seasonal basis, mid-February is kind of like that bottom area on a seasonal basis of where you want to buy. Last year was a little odd one. We had that the pink slime issue hitting as well as swine flu. That's why we had this drop when normally we're going up. So as far as right now, you got about a 2-week period where you're still going to see this cash hog situation kind of stay a little ugly. By mid-February, though, that's your time to get to change your tune and actually go direction and go long on the hogs here. So bottom line, cattle should be changing. This week's cash is going to be the key. On the hogs, stay to the lower for the next couple of weeks, but we're going to take a directional play on hogs in mid-month.
All right, thanks, Rich. And thank you, Monica, for helping out here today, too. Once again, I want to point out our road series that's coming up starting this coming weekend, or I should say on Monday. So get online, get registered for that. We'd be glad to see you guys out there on the road. And always feel free to give us a call with any questions that you have. You can reach us here at 800-262-7538 or check us out on the web at allendale-inc.com. Hope you guys had a great day. Have a good week. And if you need anything, give us a call.